Would you describe your investment methodology for the optimal income fund across asset classes and individual picks?
So for the optimal income fund, actually the first decision that we make on the fund, given that we think the performance is driven by the asset allocation, the first decision we make is a top-down decision. So it's the macro overview that we have on the world that forms our idea of which part of the market we want to be invested in. So actually the individual security selection that you mentioned is pretty much the last thing that we do. So first of all, we decide where we think the value is, whether that's in government bonds, high yield bonds, or investment grade bonds. Then we decide what kind of duration we want to take. So are we very positive on the direction of bond yields or negative? Then we look at the yield curve. So do we want to be in short dated, long dated bonds, and how we want to be getting that positioning. Then it's sector selection. And then the last thing is the stock selection. So once we've sort of decided which of the asset classes that we want to invest in, we then talk with our credit analysts to get a view on which names in those individual parts of the market are offering the most value. So that's how we do it. So we do bottom-up fundamental analysis of everything that we invest in, but it's really the last kind of piece of the jigsaw.
What is your current view on equities?
I think it depends on the reason for getting higher rates. So if you assume that actually, the Federal Reserve knows what they're doing, they will be pulling back on QE and raising rates because there is some growth, some sustainable growth coming back to the US economy, then that should be actually positive in the longer term for the riskier parts of the market. So you're right, that should be good for equities, it should be good for high yield bonds, it should be good for credit spreads in general. But obviously the thing that you have to be a bit careful about with credit is that it also comes attached with duration. So whilst corporate spreads might be attractive if growth is improving, actually if that also means that government bond yields are rising, then the two can offset each other. But if rates are moving higher because the global economy is improving, then it should be positive, all other things being equal for the riskier parts of the market. So, that is one of the reasons why, we have 10 or 12% in equities in the portfolio.
Recently, bond markets have stabilized. What is your view on duration right now?
We're still pretty wary of taking duration positions. So we do think that tapering has only been delayed. It's definitely going to happen at some point. The Fed can't keep buying treasuries back indefinitely. They get to the point where they own quite a considerable amount of the market. And also the effectiveness of QE becomes less and less as time goes on as well. Now, I think they want to exit from QE almost as soon as possible. So my view actually is that we will see the Fed, potentially even this year. I know everyone is now saying that tapering is on hold until, let's say, March, but there is definitely a risk that it happens sooner than that. There is also a risk that it happens much later than that as well, of course, but it will happen at some point. And therefore, you don't really want to be taking too much duration risk. As well as you mentioned, yields have come back down. They rallied 40 basis points or so since the highs at the beginning of September. So we're back down to lower yields than we were a couple of months ago, so there is less value again. But when tapering comes back onto the agenda, I think we're likely to see core government bond yields rise again, yields rise, and therefore you don't want to be taking definitely don't want to be taking a long duration position at this point in time. So we're still short duration. We're about 2 years short of what we consider to be a neutral position.
Why you seem to prefer higher beta names?
Our starting point for equities, obviously, when we're not equity fund managers, so we don't have to own equity. We only will own equity if we think it looks attractive relative to bonds, and then also only on an individual stock by stock basis. So Yes, we've seen the good quality part of the market do very well over the past couple of years, whereas the higher beta sectors have done less well, relatively speaking, in equities, whereas the flip side has been true in bonds. So you've had more cyclical, let's say, peripheral bonds, lower rated high yield bonds doing well, and the better quality stuff has not performed so good. So actually the relative valuation has switched around a bit, where now cyclical stocks look better value relative to cyclical bonds, which have done well. So that's where we are finding some value. Like, as I mentioned earlier, in the financial space, the likes of Bank of America, JP Morgan, recently Standard Chartered, we've just added to the portfolio. So, if we believe in a global recovery, so we want to be investing in stocks that will, be able to benefit from that, and financials is certainly one area where we think that can happen.